Good evening. I hope you all had a great day. Today, the market had a choppy day of trading. The market started off in the red, but turned green after comments made by Jerome Powell and the Fed, but ultimately they ended in the red. The S&P ended down 0.53%. The Dow posted an even worse day, being down 1.04%. Regardless, the Nasdaq did end in the green, as they ended up a nice 0.67%. Shares of Amazon and Apple gained more than 1.7% each, and both hit all-time highs. Stocks that would benefit from the economy reopening, which have outperformed in recent weeks, fell broadly. American Airlines, United, and JetBlue all dropped more than 8%. Wells Fargo slid nearly 9%, while Citigroup lost 6.1%. JP Morgan Chase traded 4.1% lower. Quote, "A large shift is occurring as investors cycle out of value in cyclical stocks for a second day and pour money into growth. Keep in mind, investors never left growth and momentum. There was a brief filtration with cyclical value over the last couple of weeks, but this was just rental positions held by tourists, as growth is still home base for the majority of the people in this market," said Adam Crisafulli of Vital Knowledge. Today, it was announced that the U.S. Consumer Price Index fell for a third straight month, as the CPI moved down 0.1% last month. However, this drop was not as bad as April's, which saw the index dropping 0.8%. This drop in the CPI is due to the coronavirus-induced recession, as it has dampered demand. This third month of falling prices could potentially spur concern about the risk of deflation across the U.S. economy. However, states are beginning to relax restrictions and stay-at-home orders, so prices do stand to increase due to the pickup in demand for goods and services. Regardless, the Fed, which targets 2% inflation, often looks to this index as a gauge of underlying price trends and attract inflation. These 3 consecutive months of declines raise fears of deflation. Powell and the Fed announced that they voted to keep interest rates near zero, and indicated that it is where they'll stay as the economy begins its recovery from the coronavirus pandemic and the induced recession. Quote, "We're not thinking about raising rates. We're not even thinking about raising rates," Powell said. He continued, quote, "What we're thinking about is providing support for the economy. We think this is going to take some time." Along with this, they announced that they believe the economy will shrink 6.5% in 2020. However, they do see GDP growing in 2021, with a gain of 5%, which is projected to be followed by another gain of 3.5% in 2022. Both are well above the economy's long-term GDP growth trend, which is around 2.2%. The Fed, quote, "expects to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals." On top of this, the Fed said that it will continue to increase its holding of bonds, with goals to reach monthly purchases of $80 billion worth of bonds and $40 million worth of mortgage-backed securities. Powell said the economic projections were made with the, quote, "general expectation of an economic recovery beginning in the second half of this year and lasting over the next couple of years, supported by interest rates that will remain at their current level near zero." For the sectors, oil and gas led the way down yet again. Today, they are down more than 4.8% on average, as the EIA, which is the Energy Information Administration, announced that U.S. crude inventory rose by 6 million barrels in the past week. Oil and gas may continue to tumble, as oil companies continue to pump oil and start making some money. Financials also took a large hit, due to the previously mentioned move of investors moving out of cyclical stocks and back into growth. The gain by tech today confirms this suspicion, as they gained close to 2.4% today on average. The Morningstar data showed the battering taken by small cap value yet again, which had shares being down 4.45% on average. Value and core stocks as a whole were battered, coming back down as investors take profits from the multiple week surge they recently experienced. The only group of stocks that gained were large and mid-cap growth, again confirming our belief that investors are taking profits from cyclicals and moving into growth. The largest positive move in the S&P 500 came from yesterday's biggest loser, Aptiv plc, which is an auto parts company. Yesterday's move down came after the company announced that they would be offering multiple $1 billion worth of stock. However, they gained 8.59% as Aptiv hops on the electrical vehicle enthusiasm wave, as Aptiv has a strong position as a supplier of autonomous and electrical vehicle technology. The other largest gain came from IDEX Laboratories, which develops, manufactures, and distributes products and provides services for the companion animal, veterinary, livestock and poultry, dairy and water testing markets. Today, they gained 6.23%, but it is not clear why this large gain came today. However, over the weekend, it was announced that IDEX had attained the mark of approval from the European Union for its coronavirus testing kit. The largest move downwards came from seemingly daily guess Norwegian cruise lines, which fell an astonishing 14.42%. This comes on the back of news that multiple states such as Texas, Arizona, and Florida have been experiencing a spike in coronavirus cases in the past couple of days. These fears have acted as a catalyst for the move out of cyclicals and back into growth in tech stocks. The other largest loser was the Gap, which is a famous clothing retailer. Today, shares fell 11.55% as they are suffering the same fate as many recent winners. Investors are moving out of cyclicals and back into growth in tech. Getting into earnings, we start with United Natural Foods, ticker symbol UNFI, which is a North American food wholesaler, specializing in organic and non-GMO options. United Natural Foods earnings were not all that terrible. They missed on non-GAAP EPS estimates by a slim 1 cent, as they came in with a profit of $1.40 per share. Revenue came in line with estimates, as they reported revenue of $6.67 billion. This represented revenue growth of 11.9% on a year-over-year basis. Adjusted EBITDA increased by an even better 32.1% to $222 million. United Natural Foods also lifted full-year guidance. Quote, "We expect elevated consumer demand for a wide variety of natural, conventional, and fresh perimeter products, along with our ongoing synergy integration initiatives, to result in a strong finish to the fiscal year," says CEO Steven Spinner. Prior to today's 20.23% move downwards, shares were up 232% over the past 90 days. Next up, we have Guess, ticker symbol GES, which is an American clothing brand and retailer. Guess missed EPS estimates by 90 cents, as they came into the quarter with a loss of $1.81 per share. Revenue came in at $260.25 million for the first quarter, but this ultimately missed estimates by $42.43 million and represented a decline in revenue of 51.5% year over year. The company says it expects a sales decrease in quarter 2, similar to the 52% drop in quarter 1. They also tipped investors that sales productivity for reopened stores in quarter 2 is roughly 75% in the US and Canada and 70% in Europe, compared to last year's levels. Guess lost an astounding 19.98% on the news of their earnings. Lastly, we have Red Robin Gourmet Burgers and Beers, otherwise known as Red Robin, ticker symbol RRGB, which is a popular chain of casual dining restaurants. Today's earnings were dismal, as Red Robin missed on both EPS and revenue estimates, although these dismal earnings were expected. However, they weren't expected to be this poor. Non-GAAP EPS missed by an astounding $5.11, as they came in with a loss of $6.66 per share. Revenue only missed estimates by a slight $12.92 million, as they came in with $306.07 million in first quarter revenue. This was a decline in revenue of 25.3% on a year-over-year basis. The company did announce that they have reopened approximately 270 dining rooms with limited capacity. This represents about 65% of company-owned restaurants. Note that Red Robin's total number of restaurants dropped by 18 on a year-over-year basis, to a current total of 554 restaurants. Shares of Red Robin fell 13.86% on the news of their earnings. However, all three of these companies also fell on the move of investors out of cyclicals and into tech and growth stocks. That is all I have for today. Thank you for watching. Currently, stock market futures are in the red. As always, I will see you again tomorrow.